Welcome to the Byte-Size Brief. Today we are putting Cheniere Energy Inc., LNG, that's LNG, completely under the microscope. Let's get into it.
Yeah, I'm really excited for this one. It's a fascinating company.
It really is. I mean, imagine a company that, doesn't actually drill for oil.
Right.
They don't explore for gas, yet somehow they basically dictate the energy security of entire continents, and they're quietly powering the whole artificial intelligence revolution.
All by acting like a giant, super cool toll booth.
Exactly, a toll booth. It's a financial marvel, really, and they just celebrated a pretty massive milestone, right?
Yeah, the 10-year anniversary of exporting their very first cargo. So if you go back to February 2016, that first shipment left Sabine Pass in Louisiana.
Wow, 2016. Doesn't feel that long ago.
I know, but think about the sheer scale of what's happened since that single ship undocked. I mean, over 4,610 cargoes have been exported since then.
That's an insane volume.
It really is. They essentially took this massive domestic U.S. energy surplus and fundamentally rewired the global energy map. Like, they literally connected the gas fields of Texas directly to the power grids of Berlin and Tokyo.
And, the stock market is definitely taking notice of that rewiring. Since we're recording this in early April 2026, the momentum here is just a genuine puzzle if you're screening large-cap energy stocks.
Oh, absolutely.
Like, year-to-date, shares of Cheniere Energy Inc., LNG, are up roughly 52%. They are just consistently hitting all-time highs. I think they're trading right up near that $294 per share mark right now.
Yeah, right around there.
And when a massive infrastructure company moves like a nimble tech startup, it makes you wonder, is the market just getting way ahead of itself here, or are we fundamentally mispricing the value of this asset?
Well, that's exactly the core debate on Wall Street right now. To figure out if a 52% run-up is justified, you kind of have to throw away the traditional energy playbook entirely.
Right, because they aren't a traditional energy company.
Exactly. If you evaluate them like a standard oil and gas producer, those companies whose fortunes just rise and fall with the daily price of crude or natural gas, you are going to misinterpret their data completely. They don't send geologists out to find gas.
They don't operate the drilling rigs.
Not at all.
So they're completely insulated from that upstream exploration risk. Like if a well comes up dry somewhere in Texas, it does not impact their bottom line whatsoever.
Not in the slightest. Their revenue generation relies on this thing called the Integrated Production Marketing Model, or IPM.
IPM, okay.
Yeah. The absolute foundation of their business is built on these long-term fixed-fee contracts. They're known in the industry as take-or-pay agreements.
Let's just break down the mechanics of what that actually means for a second.
Yeah, please do.
So when a global utility, let's say a power company in Germany or a sovereign buyer in South Korea, when they sign a contract with Cheniere, they are essentially reserving physical space inside the liquefaction facility on the Gulf Coast.
So they are renting room in the freezer, essentially.
Yeah.
A highly specialized, multi-billion-dollar freezer, yes. The client pays a fixed, predetermined fee to have their natural gas supercooled down to negative 260 degrees Fahrenheit.
Negative 260.
Yeah, it's intense. At that temperature, the gas physically condenses into a liquid and shrinks to about 1/600th of its original volume.
Which is the only way you can physically fit enough of it onto a ship to make transoceanic transport economically viable. Right?
Exactly. You can't just put gas in a balloon and ship it across the Atlantic. And here is the kicker with that take-or-pay structure. The client has to pay that fixed liquefaction fee whether they actually send a ship to take delivery of the gas or not.
Wait, really? So basically, it's kind of like an infrastructure toll booth rather than a wildcat driller.
It's exactly like a toll booth, but a toll booth where the drivers have to pay you even if they decide to leave their cars at home in the garage.
That is incredible.
That is the beauty of the take-or-pay contract. It guarantees the revenue stream. And for listeners who are trying to model the financial safety of this company, the really vital metric to understand is this. Over 95% of their total capacity is already contracted out through the year 2030.
95%.
Yeah. And a massive portion of that is locked up well into 2035 and even beyond. So this structure just virtually eliminates their exposure to the chaotic daily price swings of the global commodity markets.
Which honestly explains a really counterintuitive data point I found when I was looking at their valuation.
Oh, the PE ratio.
Yes. Despite the stock surging 52% this year, the price-to-earnings ratio, the PE, is sitting at a very modest 12. I mean, if a software company had this kind of revenue visibility and market dominance, their PE would easily be pushing 50 or 60.
Right, but the market still struggles with how to categorize them. On one hand, they operate in the energy sector, right? And that sector traditionally commands lower multiples because of those cyclical boom and bust periods.
Huh.
But on the other hand, their actual financial profile looks much more like a highly profitable, heavily regulated utility company mixed with, like you said, a toll road infrastructure overlay.
Yeah.
They've engineered a system with incredible cash flow predictability that usually commands a premium, but that PE of 12 really suggests the broader market might still be viewing them through a cyclical energy lens.
Okay, so compared to last quarter, what actually moved the needle here? Because that Q4 2025 earnings print was an absolute monster. Let's look beyond the predictability and talk about the growth.
Oh, the fourth quarter was just a blowout by almost every conceivable metric. The consensus estimate from analysts on Wall Street was that they would deliver earnings per share of $3.86.
Well,
The actual number came in at $10.68.
wow, $10.68.
Yeah, that is a 176% beat. And just to put the raw cash generation into perspective for you, they generated $2.05 billion in consolidated adjusted EBITDA for the fourth quarter alone.
And just for our listeners who might be new to that specific metric, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's basically a look at the raw cash engine of the business before the accountants start applying non-cash deductions.
Right, exactly. And that raw cash engine brought their full year net income to an incredible $5.33 billion. Plus, operationally, they exported 185 cargoes just in the fourth quarter, which set a brand new company record.
Okay, but a beat of that magnitude does not happen by accident.
Mm-hmm.
How do they actually manage to smash expectations by 176%? Because I know they've been pouring billions into building out their Corpus Christi facility down in Texas. Did that finally pay off?
It did. The physical expansion was the primary driver here. We saw the substantial completion of their Corpus Christi Stage 3 expansion. Specifically, they brought trains 1 through 4 online.
Let's clarify that term for a second.
Right.
In this industry, a train is just the jargon used for the massive multi-billion-dollar industrial refrigeration unit that actually performs the liquefaction process.
Right. Spot on. It's just a giant industrial freezer. And by getting 4 of those units fully operational, they almost doubled their spot capacity year over year.
Okay, let's define spot capacity.
Yeah.
So we are all on the same page here. We just talked about how 95% of their production is locked into those long-term contracts. So spot capacity is that remaining 5%, right? The uncontracted gas they can just sell to whoever is willing to pay the highest price on the open market on any given Tuesday.
You have it, exactly. Because they brought those new trains online so efficiently, they suddenly had about 4 million tons of extra capacity available to sell into the spot market right as winter demand was peaking globally.
Oh, perfect timing.
Right. And because they buy their raw gas at domestic U.S. prices, which are relatively low, and sell it at global export prices, their lifting margins were incredibly lucrative.
The lifting margin is basically the profit they make between buying the gas domestically, like at the Henry Hub in Louisiana, and selling it at the export dock.
Yes, exactly. But honestly, the macro environment and the new trains were only half the story. The most impressive part of that $10.68 EPS beat was an operational victory behind the scenes.
Oh, what happened?
Well, in previous quarters, their chemical engineering teams were fighting this highly technical, really frustrating issue regarding the quality of the raw gas coming into the facility. See, natural gas pulled from the earth is not just perfectly uniform, pure methane.
Right, it's a mix of stuff.
Yeah. Sometimes it comes in heavy, carrying larger hydrocarbon molecules, or it contains inert elements like nitrogen.
Wait, why does nitrogen matter to a company that's just supercooling gas?
Because nitrogen doesn't burn. And more importantly for Cheniere, it does not liquefy at the same temperature as methane. So it essentially takes up valuable space inside the pipelines and the supercooling units.
Ah, so it's essentially dead weight in the system.
It's worse than dead weight. It's an actual physical bottleneck. It literally slows down the velocity of the entire liquefaction process. But the operations team actually engineered a fix for this in Q4.
How so?
They started injecting specific chemical solvents directly into the gas stream, and they completely adjusted their operating modes.
Wait, how does a solvent fix the bottleneck?
Think of it kind of like adding a clarifier to a murky swimming pool.
Okay.
The solvent binds to those heavy, problematic chemical elements, clumping them together so they can be stripped out easily, while simultaneously allowing the plant to evacuate the useless nitrogen much faster.
Oh, wow.
Yeah. By clearing that murky gas, the pure methane can flow through the freezers at a significantly higher volume. That optimization alone unlocked a massive amount of hidden efficiency, directly padding the bottom line to the tune of that $10.68 EPS.
Hold on. If they're making record cash, why do financial screeners show a current ratio of 0.94, a high debt-to-equity ratio of 3.22, and an Altman Z-score in the gray zone for financial stress?
Ah, you looked at the Guru Focus data.
I did. And for any traditional value investor, those metrics are terrifying. I mean, a current ratio under 1.0 means a company technically has more bills due in the next 12 months than cash on hand to pay them. And a 3.22 debt-to-equity ratio means the company is heavily financed by creditors rather than shareholders. So why isn't Wall Street panicking about this leverage?
It's a vital question, and it is the exact reason why running a standard algorithmic stock screen on an infrastructure company will give you false red flags. You really have to understand the capital structure of mega projects.
Okay, break it down.
Building a single liquefaction train is an engineering feat akin to building a nuclear power plant.
Right.
It costs billions of dollars up front before a single drop of revenue is generated. You simply have to finance that initial build-out with massive amounts of debt. There's no other way.
But taking on that much debt usually suffocates a company's cash flow because of the massive interest payments.
It would suffocate a software company or a retail chain, sure, because their future revenues are unpredictable. If consumer tastes change, a retailer can't pay their massive debt load. But Cheniere has 95% of its capacity locked into 20-year sovereign contracts with investment-grade governments and massive state-backed utilities. When they go to the bond market to raise debt, the lenders are looking at 2 decades of legally guaranteed revenue. The cash flow to service that debt is practically ironclad.
So having that massive debt load isn't a symptom of poor management. It's just the required fuel to build the engine in the first place.
Exactly.
And they're actively managing it down, aren't they?
Very actively. They are de-risking the balance sheet at a rapid, aggressive pace right now. In 2025 alone, they used their free cash flow to pay down $652 million in consolidated long-term debt.
Wow, that's a huge chunk.
And currently, they have absolutely zero debt maturities coming due until 2027. That gives them a massive runway of financial flexibility. And look, if you want empirical proof that the credit markets are thrilled with this strategy, Cheniere earned 5 distinct credit rating upgrades last year across their various entities.
Really?
Yeah, bringing them solidly into investment-grade territory at a BBB+ rating.
Okay, so they have this massive competitive moat, and they are rapidly paying down that debt to secure investment-grade status. The capital efficiency has to show up somewhere. Where is all this record-breaking cash flowing next? It looks like they're pouring it right back into expanding their physical footprint.
They are. They're in the middle of a phenomenal growth phase right now.
Yeah.
We just talked about bringing trains 1 through 4 online at Corpus Christi Stage 3. Well, Train 5 just produced its first liquefied gas in February 2026.
Nice.
And Trains 6 and 7 are fully funded and scheduled to come online later this year. But management is not stopping there. The board of directors just approved the final investment decision, or FID, for mid-scale Trains 8 and 9.
Which pushes their total production target to an astounding 107 million tons per annum across all their Gulf Coast facilities.
Yes.
To put that abstract number into perspective, they are building out a single company capacity that basically rivals the total energy output of entire sovereign nations.
It's massive.
But building it is one thing. Are they actually finding buyers willing to lock up that much future capacity?
Yes, and the duration of these new agreements is staggering. They recently signed 2 massive new sales and purchase agreements, or SPAs. They locked in a contract with CPC Corporation in Taiwan to supply 1.2 million tons per annum, and another agreement with JARA in Japan for 1.0 million tons.
Okay.
The critical detail here is the timeline. Both of these contracts extend out to the year 2050.
2050. We are talking about guaranteed fixed-fee cash flows for a quarter of a century?
Yep.
I suppose island nations like Taiwan and Japan, which do not have physical pipeline connections to neighboring countries, they really have no choice but to rely on seaborne energy for their national security.
That's exactly it. They need the reliability that Cheniere provides.
But look, I have to play devil's advocate here and
Yes.
bring up the biggest risk facing the stock.
Go for it.
We are looking at a looming massive supply glut globally. You have Sempra building out their Port Arthur facility, Venture Global aggressively pricing their way into the market, and over in the Middle East, Qatar Energy is executing a massive expansion of their North Field. Analysts are projecting something like 100 million tons of new global supply hitting the market in the next few years.
Yeah, that is the dominant macro concern keeping the stock from flying even higher. Qatar, in particular, is the lowest cost energy producer in the world. When that tidal wave of new supply comes online, basic economics dictates it will inevitably put severe downward pressure on global spot prices.
It'll flood the market.
It will make the market incredibly competitive when companies try to sign new long-term contracts.
Right, but what does all that actually mean for Cheniere Energy Inc., LNG investors? I mean, if everyone else is building too, doesn't Cheniere's profit margin get crushed?
That concern actually highlights Cheniere's ultimate structural advantage. It's called the Brownfield advantage. Let me explain. When a competitor like Venture Global or Qatar Energy wants to build a brand new facility from scratch, that is called a greenfield project.
Okay.
To build greenfield, you are basically buying a coastal swamp. You'd have to spend billions just to dredge the deep water ports, reinforce the land, build massive cryogenic storage tanks from scratch, and lay hundreds of miles of pipeline interconnects just to tap into the domestic grid.
So the upfront capital expenditure is astronomical,
Exactly.
whereas Cheniere already owns the paved lot.
Precisely. Cheniere already built that foundational infrastructure at Sabine Pass and Corpus Christi a decade ago.
Yeah.
The ports are dredged, the storage tanks are built, the pipelines are flowing. When Cheniere management decides to expand, they basically just go to their construction partner, Bechtel, and say, drop another freezer right next to the last one and hook it up.
Wow, that's a huge advantage.
It is. The engineering templates are already proven. It is structurally, fundamentally, much cheaper to add new capacity to an existing brownfield site than it is to build a greenfield site from mud.
So this capital efficiency keeps Cheniere firmly positioned as the low-cost leader for new capacity in the United States.
Exactly. It provides a massive protective moat against that incoming wave of competitive global supply.
That capital efficiency is clearly generating a tidal wave of free cash flow. So let's look at how management is actually using that cash to reward the listeners who hold the stock.
Well, the cash generation allowed them to complete their 2020 Vision capital allocation plan entirely ahead of schedule. When they launched that framework back in 2022, the goal was to deploy $20 billion across growth projects, debt reduction, and shareholder returns.
Right, the 2020 plan.
Yeah, they hit that $20 billion target early, and the board immediately authorized a massive, aggressive new plan.
This was the headline that really caught my eye in the quarterly report. The board authorized over $10 billion in share repurchases through the year 2030. And on top of that buyback, they committed to growing their dividend payout by 10% annually for the rest of the decade. Management is now targeting an unbelievable $30 per share of run rate distributable cash flow.
And distributable cash flow, or DCF, is the absolute lifeblood metric for any infrastructure company. It cuts through the accounting noise and tells you exactly how much actual physical cash is left over after paying for all operations, debt maintenance, and facility upkeep.
Okay.
Hitting $30 per share in DCF is a towering achievement for a company of this scale.
Hold on, how does that actually affect Cheniere Energy Inc., LNG's stock price for regular investors like me? Wouldn't we rather just have a massive 7% yield like other midstream pipelines instead of buybacks?
It is a fair pushback. It really is. Because
Yeah.
Cheniere is taking a very different strategic approach than traditional pipeline companies, which typically pay out almost all their cash in high-yield dividends.
Right, people buy pipelines for the yield.
Usually, yes. But Cheniere uses a 60% payout ratio. Out of all that distributable cash flow, they return 60% to shareholders, but they split it. Half goes to the dividend, and half goes to share buybacks.
And the remaining 40%.
The remaining 40% is retained by the company.
Why hold back 40%? Why not just give it all to the shareholders?
It comes down to ultimate financial flexibility. By retaining a significant chunk of their cash, management can self-fund all those brownfield growth projects we just talked about, like trains 8 and 9.
Oh, I see.
They don't have to go begging to Wall Street to issue new, expensive debt at 7% interest rates, and they don't have to dilute current shareholders by issuing new stock to raise capital.
Which keeps their balance sheet clean.
Exactly. Meanwhile, that $10 billion buyback program is aggressively shrinking the total number of outstanding shares on the market. When you shrink the denominator, the share count, every single remaining share in your portfolio is suddenly entitled to a larger and larger piece of that growing distributable cash flow pie.
Oh, that makes sense. It's designed as a compounding wealth machine for long-term holders.
Exactly.
They are building their own internal growth engine instead of renting capital from the banks. That is incredibly powerful.
It really is.
But all of these shareholder returns, the massive buybacks, the 10% dividend growth, they entirely depend on the rest of the world continuing to buy American natural gas.
Let's look at the global catalysts driving that demand right now, because the geopolitical landscape feels incredibly fragile.
Fragile is an understatement, honestly. The global market has been jolted by severe, unpredictable shocks recently. Just look at the drone attacks targeting Qatar's Ras Laffan complex in the Middle East.
Right.
That specific facility is a critical node for global energy. Those unexpected disruptions temporarily stripped 15 to 20% of global seaborne supply right off the board in an
The
instant.
market reaction in Asia was violent.
Incredibly violent. Asian spot prices spiked 140% almost overnight.
140%. That's terrifying for a utility. Buyers panicked. They were scrambling to secure whatever uncontracted cargoes they could find just to ensure their power grids wouldn't fail. And this panic is not happening in a vacuum. Europe is still dealing with the long-term structural fallout of permanently losing cheap Russian pipeline gas.
Right, the war changed everything for them.
Exactly. To keep the lights on and factories running, Europe increased its imports of U.S. liquefied natural gas by a staggering 27% last year alone.
Wow.
Entire nations are essentially tethering their economic and energy security directly to the U.S. Gulf Coast.
So the geopolitical premium on American gas is massive and structurally entrenched. But there's another demand story dominating retail chatter right now, especially on finance boards and Reddit.
Let me guess. Artificial intelligence.
You got it. The argument goes like this. AI data centers require an astronomical amount of baseload electricity. We're talking gigawatts of power to train these large language models, and renewables like wind and solar simply cannot provide the constant 21/47 uninterrupted power required to keep those servers from crashing. The grid essentially has to build natural gas power plants to meet the AI demand.
And they're right. The physical power requirements for these next-generation AI models are immense, and natural gas is widely viewed as the only logical, scalable bridge fuel capable of providing that reliable baseload generation on domestic soil.
But here's my concern. If AI eats up all our domestic gas, does that cause affordability issues that choke off the export permits for Cheniere Energy, Inc., LNG? I mean, if the price of gas skyrockets to heat American homes because tech companies are buying it all, politicians are going to point the finger straight at the exporters and try to cap them.
It is the most common bear thesis out there, but it fundamentally underestimates the sheer geological scale of U.S. gas reserves. The U.S. is sitting on massive trapped resources in places like the Permian and Haynesville basins.
Okay, but is it enough?
Let's look at the historical data. A decade ago, U.S. production was around 68 billion cubic feet per day. Today, despite exporting massive quantities globally, domestic production has surged to over 110 billion cubic feet per day.
Wow.
The drillers have proven they can easily ramp up output to meet both domestic AI data center demand and international export demand simultaneously.
But can the pipeline infrastructure physically move that gas from the Permian Basin to both the AI data centers on the East Coast and the export terminals in Louisiana at the same time without creating a massive logistical bottleneck? If pipeline capacity gets constrained, domestic prices at the Henry Hub will inevitably spike.
Right.
Doesn't the domestic price spike crush Cheniere's profit margins?
It would crush a standard utility, but not Cheniere, and this is the brilliance of their IPM contract structure. Domestic gas prices, that NYMEX Henry Hub price you were talking about, is a pure pass-through cost for them.
Wait, a pass-through cost?
Yes. When a buyer in Japan signs a contract with Cheniere, they legally agree to pay the actual cost of the raw domestic gas, whatever it happens to be that day, plus Cheniere's fixed toll booth liquefaction fee. So if domestic pipeline bottlenecks cause Henry Hub prices to double, the foreign buyer absorbs 100% of that cost increase.
Yeah.
Cheniere's profit margin on the physical liquefaction service remains perfectly intact.
They are completely contractually insulated from domestic commodity price spikes.
Exactly.
That is an incredibly resilient business model.
Yeah.
You really have thought of every angle. Let's briefly recap what we've unpacked today.
Sure.
Cheniere just delivered a jaw-dropping Q4 beat with $10.68 in earnings per share. They proved their engineering prowess by solving complex nitrogen bottleneck issues to run the facilities at peak efficiency. The board authorized a massive $10 billion buyback program alongside a 10% annual dividend growth commitment.
Yep.
And they are using their brownfield cost advantage to aggressively expand capacity while competitors struggle with the astronomical costs of building greenfield projects in swamps. all while riding massive macro tailwinds from geopolitical shocks and AI power demand that drove the stock up 52% year to date.
It is undeniably a powerhouse of a company, but as always, we want to leave the listener with a paradox to think about.
Hit us with it.
We spent this entire deep dive praising Cheniere's ironclad safety net, the fact that 95% of their capacity is locked into fixed, long-term take-or-pay contracts.
Right.
That structure absolutely protects them from price crashes and supply gluts. But what happens if global spot prices go absolutely parabolic due to severe, prolonged geopolitical shocks in the Middle East?
You mean if prices stay at that 140% premium for years, not just a panicked few weeks?
Exactly that scenario. If the global market is desperate and paying massive sustained premiums for uncontracted gas, Cheniere will be contractually stuck collecting their fixed, predetermined tolls on 95% of their production, while the uncontracted, purely merchant players cash in on the absolute peak of the market.
Wow.
Does their ultimate financial safety net eventually cap their upside in a hyper-volatile world?
That is a fascinating paradox. They are the undeniable blue chip of the blue flame. But absolute safety always comes with an opportunity cost. All right, listeners, what's your take on the future of Cheniere Energy, Inc., LNG? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Bite-Size Brief.